The fundamentals of price discrepancies. In arbitrage trading, price discrepancies are the core driver of profits. These discrepancies occur when the same asset or security is priced differently in various markets, trading platforms, or regions. A trader who identifies and acts swiftly on these differences can execute profitable trades by buying in one market at a lower price and selling in another market at a higher price. This fundamental principle underpins all arbitrage strategies and highlights the importance of understanding the various factors that lead to price discrepancies. Causes of price discrepancies. Market inefficiencies. Market inefficiencies occur when prices do not accurately reflect all available information about an asset. In an ideal, perfectly efficient market, there would be no price discrepancies because prices would adjust instantly to reflect new data. However, real markets are not always perfectly efficient, and inefficiencies often arise, creating opportunities for arbitrage. One common inefficiency is informational asymmetry, where not all market participants have the same access to information. Traders with better or faster information can exploit this asymmetry by buying undervalued assets before the rest of the market catches up. Similarly, market structure inefficiencies, such as differences in liquidity or transaction costs between markets, can create temporary price discrepancies that can be capitalized on. Another major cause of price discrepancies is supply and demand imbalances. When supply and demand for an asset vary between regions or markets, the price will naturally reflect these differences. For example, a commodity such as crude oil might be priced higher in one country due to strong demand, while it is priced lower in another country with less demand or more abundant supply. Traders can exploit these spatial discrepancies by buying in the market with lower demand and selling in the higher demand market. These imbalances are not limited to commodities. They can occur across all types of assets, including stocks, bonds, and currencies. Transaction costs and barriers to trade. Transaction costs, such as brokerage fees, taxes, and spreads, can also lead to price discrepancies. For example, a stock might be priced differently on two exchanges if transaction costs, such as commission fees, are higher on one exchange than the other. Arbitrage traders must account for these costs when evaluating whether a price discrepancy offers a true profit opportunity. Additionally, barriers to trade, such as tariffs, taxes, or regulatory restrictions, can prevent prices from converging across markets, creating sustained price differences. For example, a government-imposed tariff on a certain commodity might cause it to be priced higher domestically than on the global market. Traders who understand these barriers can exploit these structural differences. Currency exchange rates. Fluctuations in currency exchange rates can also cause price discrepancies, particularly in international markets. An asset priced in one currency may appear undervalued or overvalued when converted into another currency. For example, if a stock is priced in euros and the euro weakens against the dollar, the stock may seem cheaper to a US investor when converted into dollars. Traders who monitor exchange rates and understand their impact on asset prices can exploit these discrepancies through currency arbitrage. Market sentiment and behavioral factors. Market sentiment, how investors collectively feel about a particular asset or market, can drive prices away from their fundamental values, creating temporary price discrepancies. During times of optimism, investors may push asset prices too high, while during periods of pessimism, prices may drop below their true value. Traders who can identify these emotional overreactions can profit by buying undervalued assets or selling overvalued ones before the market corrects itself. Regulatory differences. Variations in regulations across different countries or markets can lead to price discrepancies. For example, a stock might be subject to stricter disclosure requirements or tax treatments in one country compared to another. These regulatory differences can cause the same stock to be priced differently in different markets, creating arbitrage opportunities for traders who understand the legal landscape. Types of price discrepancies. Spatial discrepancies. Spatial discrepancies occur when an asset is priced differently in different geographic locations. These can arise due to differences in supply and demand, currency exchange rates, or even local market regulations. For example, agricultural products like wheat or coffee may be cheaper in regions where they are produced in abundance, but priced higher in regions where they are scarce. Spatial arbitrage involves identifying these geographic price differences and buying the asset in the lower price location, while selling it in the higher priced one. The profit comes from the price difference after accounting for transportation or other costs involved in moving the asset from one market to another. Temporal discrepancies. Temporal discrepancies arise when there is a lag between the time it takes for prices to adjust across markets. For example, during a period of high volatility, a stock price may rise quickly on one exchange, but take longer to adjust on another exchange. Arbitrage traders can take advantage of this time lag by buying on the slower reacting market and selling on the faster reacting one. Such opportunities are often brief, and traders must act quickly to capitalize on them before the markets correct the price difference. Inter-market discrepancies. Inter-market discrepancies occur when an asset is priced differently across related markets. This often happens when assets with a close financial relationship, such as a stock and its corresponding options or futures contracts, are temporarily mispriced. A classic example is index arbitrage, where the price of a stock index may diverge from the combined price of its constituent stocks, offering a short-term arbitrage opportunity. In these cases, arbitrage traders can exploit the mispricing by buying the lower-priced asset and selling the higher-priced one, expecting the prices to eventually converge. Cross-asset discrepancies. Cross-asset discrepancies arise when related but different assets are mispriced relative to one another. For example, a company's stock price and its convertible bonds may move out of alignment due to market inefficiencies, creating an opportunity to buy the undervalued asset and sell the overvalued one. Traders who understand the financial relationships between different asset classes can identify and act on these cross-asset discrepancies to make a profit. Identifying price discrepancies. Successful arbitrage trading depends on the ability to quickly and accurately identify price discrepancies. Traders use a variety of methods to do this. Comparative market analysis. This involves comparing the prices of an asset across different markets or exchanges. Tools such as price monitoring software and real-time data feeds allow traders to track prices across multiple platforms, making it easier to identify discrepancies as they arise. Technical analysis. By studying historical price data and identifying patterns or trends, traders can anticipate when price discrepancies might occur. Technical indicators such as moving averages or Bollinger Bands can help signal when an asset is overbought or oversold, offering a potential arbitrage opportunity. Fundamental analysis. This method involves evaluating an asset's intrinsic value based on its financial performance, industry conditions, and economic factors. If the market price of an asset differs significantly from its intrinsic value, it may represent an arbitrage opportunity. Statistical arbitrage. Using sophisticated mathematical models and historical price data, traders can identify correlations between related assets. When the prices of these assets diverge from their historical norms, arbitrage traders can capitalize on the discrepancy. Challenges in exploiting price discrepancies. While price discrepancies offer profitable opportunities, there are several challenges that arbitrage traders must navigate to exploit them effectively. Timing and execution. Risk. Timing is crucial in arbitrage, as price discrepancies often correct themselves quickly. Traders must execute their trades swiftly to lock in profits before the markets converge. Execution risk arises if trades cannot be completed at the desired prices, which can erode or even eliminate the potential profit. Transaction costs. High transaction costs, including brokerage fees, taxes, and the bid-ask spread, can eat into arbitrage profits. Traders must carefully consider these costs when evaluating whether a price discrepancy is worth exploiting. Liquidity. Sufficient liquidity is essential for successful arbitrage. In some cases, limited market access or low liquidity can make it difficult to execute large trades without significantly impacting the market price. This can reduce the profitability of arbitrage opportunities or, in extreme cases, prevent traders from exploiting the opportunity altogether. Conclusion. Understanding the fundamentals of price discrepancies is a vital part of mastering arbitrage. These discrepancies arise from a variety of factors, including market inefficiencies, supply and demand imbalances, transaction costs, currency fluctuations, and investor behavior. By recognizing these factors and using the appropriate tools to identify discrepancies, traders can exploit arbitrage opportunities and generate profits. However, success in arbitrage requires not only knowledge of these fundamentals, but also the ability to navigate the challenges of timing, liquidity, and regulation.